If you're looking for a strong ETF to track the US stock market all in one purchase, you may come down to the choice between the popular S&P 500 ETF VOO or the Total Stock Market ETF VTI. Both of these ETFs are among the largest ones in the market based on their total assets under management, but they do have slight differences that are crucial to know about. Now, before we get started, my name is Danny Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, let's first explain the Vanguard S&P 500 ETF with the ticker VOO. Now, VOO tracks the S&P 500 index, which means it represents 500 of the largest US-based companies, and do know that both VOO and VTI are considered market cap weighted indexes, which pretty much means the larger the company is, the more weight it carries to the fund's performance. So looking at VOO, you can see the companies that carry the most weight include Nvidia, Microsoft, and Apple, each making up over 6% of the entire fund. And because of that, when you buy VOO, the largest sector you're getting exposure to is information technology, which makes up over a third of the entire fund itself. Not to mention, but this fund is also super cheap, coming in at a 0.03% expense ratio, which is the cost it takes to own the fund per year, and do know that that is automatically taken out of your investment over time. It's not something that you're going to have to pay separately. To show you how small that number is, for every $10,000 that you invest, you would end up paying $3 per year in fees, which is equivalent to the price of a cheeseburger. But not just is VOO cheap to own, but historically it has done very well for investors, where you can see over the past 10 years, VOO has averaged a return of 15.26% per year. To see that impact, if you invested $10,000 into it 10 years ago and you added every single month $500, by today you would now have $173,000. But fun fact to know is that the S&P 500 goes way back, and since 1957, the index has averaged an annual return of 10.54%. So if we now say that you do this for 30 years throughout your career rather than 10 years, with that average, you would end up having over $1.3 million, and that last year alone, your portfolio would have grown in value by $128,000. And so because of the power of compound interest, which means the longer that you invest, the more time you have for your investments to compound with the growth, if you invested for another 10 years, your portfolio would have jumped all the way up to almost $4 million, where you can see the majority of that growth came from the last few years, where that last year alone, your portfolio would have grown $359,000 instead. All in all, by investing into a broad market index fund, you are able to gain great diversification to the market while reducing the downside risk of not having to own only a couple of individual stocks. But don't get carried away yet, because the next ETF offers even more exposure, which may be very convenient for you depending on what you're looking for, and that is through the popular Vanguard Total Stock Market ETF with the ticker of VTI. Now, VTI actually includes more than just the S&P 500. This index tracks the performance of the CRSP US Total Market Index, which means it provides exposure to large, mid, and small cap stocks across both growth and value styles. The fund is also very cheap with the same 0.03% expense ratio, and it contains over 3,500 different stocks all within this one purchase. And so if we look at the top 10 holdings, they're also very similar because these companies are among the largest and make up the most weight, but now they have slightly lower weight to the fund, being each about 1% lower than what the S&P 500's was. And interestingly enough, the technology exposure here makes up the largest of the sectors at 38%. And because this is so similar to the S&P 500, looking at the amount of overlap, you can see that there is an 88% overlap by weight. So if you are thinking to buy both, realize that VTI is very similar and that you are nearly duplicating your exposure by a significant amount. And because of that significant overlap, looking at the averages over the past 10 years, the fund has averaged 14.67% per year, which is just slightly lower than the S&P 500. All in all, if you want to own nearly all publicly traded companies in the US, this is the easiest go-to investment, giving you exposure from very small companies you've probably never heard of to the largest ones that make up a large percentage of the fund. Knowing that, let's now finish this off and go over which ETF should you choose. Now, when it comes to VOO, the S&P 500, the legendary investor Warren Buffett says, for most investors, the best investment strategy is to own an S&P S&P 500 index fund. In fact, he even won a $1 million bet with hedge funds that the S&P 500 would outperform them over a 10-year period, and the results weren't even close. But knowing that the S&P 500 is already a great investment that I personally love as a foundation to any investment portfolio, the choice isn't whether to pick the S&P 500 or not, but whether you want more exposure by investing into the Total Stock Market ETF that was VTI. So to sum up the difference for this choice, VOO is focused solely on large cap stocks, offering less exposure, but historically it has provided slightly higher returns for investors. Where for VTI, you would gain more exposure where it now includes large, mid, and small cap stocks, giving you more diversification, but historically that typically generates lower returns over time. Both have the same cost and are very identical, so the choice may really come down to the convenience on what you want. If you are one that wants to simplify the most and have the least amount of investments, VTI would be a simpler strategy. But if you like the idea of owning solely the S&P 500 and then customizing your own investments thereafter, you could also buy small and mid-cap index funds like VB or VO and control how much exposure you have to each completely on your own. But regardless on picking VOO or VTI, you are still investing into the majority of the US market, so don't overthink the decision. Pick a strategy that you like, stay consistent with it, automate your investments to make things even easier. You can learn more from content like this, and then let the compounding do the work. Now, if you want to see the data for these investments all in one place and other top index funds in the market to consider, I'll have an entire index fund cheat sheet that I created linked in the description below. And don't forget, if you want to start investing on a new platform, I'll have a direct link below to some of the top ones that you could learn more about and get started with. End of the day, our mission at InvestLane is to help you save and invest wisely to build lasting wealth. So please do whatever you believe is best for your situation. This is not financial advice, and you must do your own research. Now, if you found value in this video, don't forget to hit the like, subscribe, and notifications button for future content like this.